to the War Hunt quarterly market update for 30 June 2023. My name is Bianca Musico and I am an advisor here at War Hunt, and I'm joined by Steve Garth, a member of our investment committee. Thanks for joining us, Steve.
Thanks, Bianca. Great to be here.
Not a worry. Now we're here to talk about what's been happening with markets, both domestically and internationally over the last quarter predominantly. Last year wasn't a great year, and this year seems to be doing a lot better. It started off with quite a rally. I think it's the strongest we've seen for the last...
For many years. That's right, Bianca. Why don't we just look at Australia to start with? Not only can you see the market, it's up 4.4% over the last 6 months, which is pretty good, but it's up 14.4% over the last 12 months. So that's a really good return. And the other thing you notice in this chart, Bianca, is that the volatility keeps going down. So it's the lowest volatility for many years. So markets are going up, volatility is going down. Happy days in the Australian market.
Perfect. What about international markets? So obviously Australian markets are doing quite well, but we noticed that in international markets they're doing even better.
They are doing a lot better. Have a look at this first chart that shows the return of the developed markets. That's 17.5% is return of the developed markets ex-Australia. And you can see there that all markets are doing well, particularly the US. It's up by 19% in the first half. But other markets, Europe, might surprise you with what's going on over there. And Japan, who would have thunk, because Japan economy normally goes nowhere, but the stock market's actually had a really strong first half of the year. It's really only the emerging markets that are lagging, Bianca, and that's really because China makes up about 33% of the emerging markets. And even though they've come out of that COVID lockdown period, everyone was expecting the Chinese economy to take off. It hasn't done that yet. So the emerging markets, or principally China, are a bit of a laggard on global returns.
Talk to us quickly on these Magnificent Sevens, which I think our clients have exposure to, which is great.
Absolutely. Your clients do have exposure to it. So we just talked about how well the US is going. Let me break that down. The index that you hear on news all the time is called the S&P 500. It's the top 500 companies in the US. But it's made up of companies from two different exchanges. One is the New York Stock Exchange, and the other is the NASDAQ. Now, the NASDAQ is where the big tech stocks live. And you can see this huge discrepancy in returns that the older companies on the New York Stock Exchange aren't doing much better than Australia, to be honest. They're just kind of lagging behind a little bit. But the high-tech stocks on NASDAQ, they're up an incredible, 30%. They were down 30% last year, so let's put it in perspective. And you use the word the Magnificent Seven, and that's right. The top 7 companies in the S&P 500 are, in fact, all on the NASDAQ, and they're the Apples and Microsoft, and a company that most Australians would not have heard of a few months ago called NVIDIA. It's now the top 3, and NVIDIA makes chips, and there's this AI craze going on. Everyone wants to hop on the artificial intelligence bandwagon, and in order to make AI work, you need the chips, and NVIDIA makes chips. So that's up an extraordinary 180% year to date. So it is those large tech stocks, the Magnificent Seven, that is driving the US market, in fact, driving most of the developed markets.
Perfect. And let's touch a little bit on the bond markets.
Well, the equity market seems to think that we've hit this terminal rate and so life is all good. The bond market is not so sure, and you can see in the chart here that yields keep rising. Now, yields rise on the expectation of where the terminal rate will be. And you can see that they keep on re-estimating where that terminal rate will be. And of course, when yields go up, prices go down. So you can see, while it's a positive half year for bonds, it's certainly the last quarter, a little bit negative. The good news is, Bianca, the bond market too is saying, look, we're really close to this terminal rate. We're not expecting rates to go much higher than where they are.
Well, thank you, Steve, for that detailed summary on what's been happening over the last quarter or so. And thank you all for joining us for this end June quarter update. As you've heard us say many times over, evidence-based investing for us is quite important, as it ensures that our clients' best interests really are at the forefront of everything we do, and it safeguards your financial future. So thank you again for watching, and we'll see you next quarter with an update. Thanks, Steve.
Thanks, Bianca.